Hello to you all who are watching this video. Welcome you to Global Forex Academy, Learn How to Trade. We are in connection with the Global Forex Institute of Africa and also in connection with exclusive Forex Trading Academy. Thank you very much for joining us. This video is dedicated to all of our students and to all those Forex trading beginners, those who want to learn about the Forex market and the stock market, the CFDs on shares and commodities trading, and also future trading and things like that. Thank you very much for joining us, and thank you for watching this video. If you truly like our content, can you please subscribe to our YouTube channel, and also go to Facebook and join our exclusive investors dash Forex trading guidelines, and also keep in touch with us. Thank you very much. Before we begin, let's read our disclaimer here. Just wanna increase it so that you can see it. There we are. This is our disclaimer, copy and pasted to this particular lecture here, presentation. Let us read our disclaimer. Risk warning. This video is for general information only, and it is not intended to provide trading or investing advice or any personal recommendations. Therefore, the information in this video is indicative and may become out of date at any time. The producer of this video shall not be responsible for any loss that you may incur, either directly or indirectly, arising from any investment based on any information in this video. Any information relating to the past performance of an investment does not necessarily guarantee future performance. Please remember that trading and investing carries significant risk due to rapidly moving markets and may not be suitable for all investors. Losses, especially when trading leveraged instruments, can in some cases exceed your account balance. You should therefore obtain independent investment advice and ensure you fully understand the risk involved before trading or investing. This information contained in this video does not contain investment advice or recommendation on the purchase or the sale of any securities. Thank you very much for that. Let's move on now. We are going to be talking about candlestick construction. There are 12 major candlestick signals that one needs to learn and be aware of when you trade daily or whenever you trade, be stocks, be futures, be your commodities, be your Forex currency and cryptocurrencies and the other types of instruments or securities that you may trade. There are 12 patterns of candlesticks that generally do appear on your charts, So my advice is, be aware of those, learn them, and understand how they work. They can help you to become signals. They can help you how to enter a trade and also exit a trade. Okay? So those 12 patterns, I will name them later, but for now, we are going to be dealing with the candlestick construction. All the types of candlesticks construction you can find on your chart when you are trading, I will be dealing with them here. Now, notice that this particular presentation is a lesson, okay? It's educational lesson. So we are offering this lesson on a class form system, okay? You can contact us and we will be able to send you these videos personally. And we are charging for our services because this is a company. This is how we generate income. This is how we make money. Again, we are also trading on the other side. But on the educational side, these videos are made specifically for educational purposes, not investment purposes, but educational purposes. You will learn a lot of things here that you can apply on your trading platform and make money, but we are not guarantee you that you will be profitable every single day, every single trade that you take. Okay, you need to be disciplined, you need to be dedicated, you need to dedicate your time to learn how to trade and to learn the candlesticks constructions. You need to learn the patterns, you need to learn price action, you need to learn how to read your technical indicators, analyze your markets, like your charts, and also your fundamentals, geographical, economical, and political. Okay, so having said that, let us begin. Candlestick construction. What are candlesticks constructions? When we talk about the candlesticks construction, we are talking about the pattern that develops when a candlestick takes formation. Okay, you will see them as I go through. You will see those particular patterns and formations. We call them constructions. Okay, now let us begin with explaining what is a candlestick. Okay, now first of all, candlesticks were founded by the Japanese rice traders, rice merchants. They used to use the candlestick constructions or formation to set the prices for their product, and to see the demand, and also to see the supplier of their product. So candlesticks were used actually as a price action pattern to see whether rice is being bought in a higher level, or whether the supply of or the demand of rice is declining. Okay, so now, as we all know that stock trading started in Europe, as the rice merchants were traveling to Europe, and the Europeans, they were traveling to Asia, they adopted this measurements and this style of price action, and they took that candlestick system. They introduced it to the stock market to make the stocks easily to understand, easily to be traded upon. Okay, so having done that, this same way candlestick construction patterns and formation, they found their way also into Forex trading also. Okay, so hence today we are having these candlesticks also being used in Forex trading. So now, what is a candlestick? But it's called a Japanese candlestick because it was founded in Japan, in Asia. Now, a candlestick is used to describe the price movement during the given time frame. So, as you are trading, you will notice that you are trading on a time frame chart. Okay, you don't just trade generally. You are trading on a time a frame chart. So in Forex trading, we are having multiple of time frame charts. The first one is that one of 1 minute time frame chart. You will have that one of 15-minute time frame chart, and then you will have the 30-minute time frame chart. You will have the 1 hour time frame chart. You will have that one of a daily time frame chart. You will have the, after 1 hour comes the 4-hour time frame chart. Then you will have the daily time frame chart, and then you will have the weekly time frame chart, and then you will have the monthly time frame chart. So all these time frame chart, they give you as a trader a chance to trade on whatever time frame you choose, because the patterns and the movements will not be the same to each other. But you can use other time frame to trade on other time frame. Okay, we call that confirmation of a trend, or the confirmation of whether you are at the resistance or at the support level. Then you may apply that system on another time frame chart. Okay, so a candlestick consists of a body, and it consists of an opening price, and it consists of a closing price. Okay, and a candlestick, when it constructs itself, it will have two types of movements. As it opens at the price, at the certain level price, it can push itself to a higher price than the previous opening price. And as it pushes itself to a higher price, we call that a high. And it can also push itself to a lower price than where it opened originally, and we call that a lower price. And then it closes. Now let me give you two types of candlesticks. We have the bearish candlestick, we have the bullish candlestick. Okay, now the bearish candlestick, most traders, they use a red color to identify the bearish candlestick. So on my screen there, on your right side, you can see that there is indication of red candlestick, and on the left there's a green candlestick. So now let us start on the red candlestick. You look at it, it is called bearish candlestick. This is a selling candlestick. And then you have two arrows above and you have two arrows down. You look at the shape of the candlestick, and between there it is written real body, and this real body has two lines, the one at the bottom and the one up. You look at where the first arrow is indicating, it is written open. The second arrow up there, it is written high. We go down, we look at where the first arrow is pointing. It is pointing at the close, and the next one, it is pointing at low. Now, all those two indications above there, that line that is pointing up there, that line that is above the real body, it is called an upper shadow. Okay, it's called an upper shadow. And then you look downwards, the line that is pointing down there, it is called a lower shadow. So that line up there and the line down there is they have a name. Both those lines, they are known as wicks. Okay, they are known as wicks. So these wicks, they have two arrows pointing where the line begins attached to the body, and where the line is pointing up there. So a bearish candle opens high above. It opens high. So as it opened, it went up to the direction of the upper shadow. You see that direction there, it went up. And where it stopped, where that line stopped, it is called high. And the candlestick, what it did, it went down again to the point where it is written lower shadow. It reached the point where the arrow is pointing at low. That's where it stopped. And then it pushed back up again to the point where the arrow is pointing close. So let's make an example of this. Time frame was 5 minutes. That simply means this whole candle construction or formation took 5 minutes to construct. There where it is written open, where the arrow is pointing open, that's where it opened. That is where our first minute started. Let's say, for example, it went higher to that arrow where it's pointing high. Let's say it took another minute, that's 2 minutes. And let's say it went down to the point where it is written low, right? Or let's say it went halfway to the real body there. The real real body, half of it, let's say that's where the candle stopped for another minute. That will be 3 minutes. And let's say it pushed itself down again to the lower shadow and it stopped where it is written low. That's 4 minutes. Let's say it stopped there for 4 minutes. And 4 minutes passed and then the candle went back again to where it is written close. Let's say it took the whole minute again to get where it is written close. And that's where it closed. That is the 5th minute. So the whole construction of this candle took 5 minutes. That's what we say when we refer to time frame: 1 minute, 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hour, day, week, and month. That simply means this one candlestick takes that period to open and to close. One candlestick. So let's move to the second candle type there. You are looking at your screen now. Look at your left side. You are looking at the green candlestick formation there. Now this green candlestick is better known generally as the buying candlestick, the bullish candlestick. Most traders, again, we apply the color to be green, but you can change and modify the colors of these two candlesticks according to how you like your colors. But generally 90% to 99% of traders, they modify these colors to be red and green or black and white. Okay, but for now we are looking at the red and green. So let's look at the bullish candlestick. Now notice there are two changes here. Look at the bearish candlestick, the selling candlestick. Where it opened, the green candlestick, that is where it closed. And where the the bearish candlestick closed, that's where the bullish candlestick opened. So a bullish candlestick opens at the bottom, at the lower side of the price, and it pushes itself up. That's how a bullish candlestick works. It goes up and it gives you a bullish construction, or it gives you a buying signal. Okay, so now let's look at it. A bullish candlestick, it opened where it is written open, lower shadow. Look at the lower shadow down there. You see there's an arrow that is indicating open. That's where your bullish candlestick started. And what happened is that it went down to the lower side. It went down to lower shadow. You see where that arrow is pointing low, where that stick ended, that's where the candlestick pushed itself to that price there, the lower price. And again, remember, that's about 2 minutes now. And then it pushed itself up, let's say in the middle of that real body again. It stopped there, that will be 3 minutes. And it pushed itself up to the point of the upper shadow, the high, where the arrow is pointing high. That's where from where it was stopped between the real body there, it went up as high as that point high there. Let's say that's 4 minutes. It stopped there. And then, sorry, what it did is that after 4 minutes, going to the 5th minute, it pushed itself down a little bit to the point where it is indicated close. That is how the candlestick works. When you trade as a trader, that is how you should read both of this type of candlesticks. That is how you should know them. You must study them and you must know them. Because as a trader, you cannot make profit if you are trading candlesticks and you do not know where they open and where is a bullish candlestick or where is a bearish candlestick. If you don't know how they operate, if you don't know a bullish candlestick is what, how it opens and where it closes and what construction it forms, you will never be profitable as a forex trader or as a trader in general, or even as an investor generally, if you are using candlesticks. So I think we have exhausted the candlestick construction. Now let us go to the definitions. What is a candlestick pattern? A candlestick pattern is a graphic formed by the movement in the market price and contains predictive power in the next market direction. I want you to understand this definition correctly and listen to it carefully, because now we are getting into patterns. Remember what we talked about there? Up there it was construction of a candlestick, how a candlestick constructs itself. Now, candlesticks do form patterns, like as they line to each other, as bearish and bullish candlestick forms next to each other. They construct a pattern as they go up and down, moving in straight lines and up and down and things like that. They are busy constructing what we call a pattern. So you must familiarize yourself with those patterns. What is a pattern? It is a graphic formed by the movement in the market prices and contains a predictive power in the next market direction. So a candlestick on its own is called a price action. That simply means a candlestick gives you the direction of the price of that particular commodity or security or a currency that you are trading, or you just investing in, or you just bought, or you just sold. A candlestick will give you the price of whether this particular asset is going up or is going down, or this particular price it is at the equilibrium level, whereby the price is not up, the price is not down, but the price is just in the middle. Okay, so now let us look at other definitions. How is a candlestick formed? A candlestick is formed by using the opening price. Let's go back to our previous example. Look at both the red and the green candlestick. You see where the indication is indicating open, where that arrow is indicating open. That's where a candlestick opened. Both the bullish and the bearish candlestick. You see that? And also the closing price. You see where the candlestick has closed there, the bullish one, and you see where the candlestick has closed there, the bearish one. And the highest price and the lowest price of the given time frame. Now, both of these candlesticks, the bearish and the bullish, they do have the highest price and the lowest price attached to them. Now, this is a candlestick formation.